All right, now let's go over what a DSCR loan is and how you qualify for a DSCR loan. Right now, we're going to go over some terms and conditions that are common. So normally, DSCR loans, you can qualify with either a 620 credit score up to a 680 credit score. What is a DSCR loan? It's basically a loan where you're going to be able to purchase a home as an investor. So it's not going to be something you're going to live in, you're going to rent the property out. And now let's go over some of the terms before we move on. So basically, a debt service coverage ratio is a type of mortgage used for purchasing short-term or long-term rental investment properties. So this does include Airbnb properties, by the way. With a DSCR loan, most borrowers will be able to qualify on the rental income only, which is what you would be doing, which would be a rental analysis. And no personal income or employment information is ever collected or required on the application. So you're just going to leave it blank. The debt service ratio coverage is, or the DSCR, which is what it's commonly known as. It is basically a way to measure the property's expected cash flow to determine ability to repay the mortgage loan. So for example, if the mortgage payment is $1,000 and the borrower's rental income is $1,200, then you would divide 1,200 by 1,000, and that would be 1.2, and it's above 1, which is what most lenders need. Now, how do you calculate this? It's basically by calculating by either dividing the borrower's net operating income, which is the rental income, by their obligations, including the debt payment. So how would you do this? You would go ahead and add up all the borrower's payments that they have to make on the home. The rental income would be what you would be using to divide by. So what is the total debt payment? It's usually the mortgage payment, taxes, insurance, HOA payments, or anything else that needs to be included in that calculation, which could also be flood insurance or any other type of flood insurance. Next, let's go over some of the important program highlights for this type of loan. With different lenders, there's going to be a minimum loan amount and a maximum loan amount. For our specific case, for this lender, we're going to see that the minimum that they have is $100,000. And then the maximum that they allow is $3 million for this type of loan. And you can either purchase, refinance, cash out, or just a rate and term refinance, which is basically that you're not taking cash out of the home. Next, short-term rentals are allowed. All the lender's going to need is an Air DNA report, which is perfectly fine. Or they would do their own analysis by having a comparable rent analysis completed. DSCR needs to be under 1, and no DSCR options are available. Because when you have a DSCR loan, you're going to calculate what the difference is, or the percentage of rental income versus what their payment is going to be. But there's also programs where they don't even calculate that. So it's basically what they call a no ratio loan, because you're not even going to calculate that, which means all the borrower really needs is to have the down payment, credit score, and be able to close on a loan. That's it. The lender's not really going to ask for much. No income or employment is required to be able to qualify, because we're mainly qualifying the property based off the rental income, which is also known as the cash flow of the property. Maximum of 5 loans with AOMS, and exceptions considered when there are more than 5 loans. What are exceptions? Basically, sometimes when there might be something that might not fit the lender's guidelines, then the lender can create or allow an exception. But that's on a case-by-case basis, and it's not something that's consistent on every situation. The maximum LTV, or loan to value, is usually 75 to 80%. With this specific lender, it's 85%, okay? In order to be able to qualify for that LTV, they need to have at least a minimum 720 FICO, or 720 middle credit score. Now let's move on a little bit further down. Properties can close in the name of either an LLC, corp, or revocable trust. This is very important. Most of these DSCR or investor loans will require that the borrower close in the name of an LLC, because that way they can go back and request that the payment be made back to the lender in terms of getting repaid. And what that will basically mean is that if it's in the name of a corporation, it's much easier to foreclose on the property and get their money back, or else the lender simply won't close on that loan, because they know that for them it's going to be much harder to collect those funds. Interest-only loans are available and gift funds are okay as well. Interest-only loans are basically where you would not require the borrower to pay principal back, just interest only, because the investor's focused on making on the total cash flow that they receive and not the principal repayment. So what does that mean? Basically means that the borrower is not interested in paying down the loan. They simply want to keep getting money back from the rental income after making the mortgage payment. And this lender allows you to do that by having an interest-only loan. They also allow permanent and non-permanent residents allowed to be able to close on this loan. Now, what type of borrowers are allowed to close on these types of properties? Well, U.S. residents, permanent and non-permanent residents are allowed to be able to close on these types of loans. Also, interest-only loans are available and gift funds as well are okay. So what does that mean? It means that a family member can give them the funds they need for the down payment, which is really a huge benefit to anybody that wants to invest. The only catch is that most lenders don't require first-time home buyers when it's an investment property, simply because they have no experience as landlords. Next, we do have up to 6% seller's contribution, which means that 6% can go to buy down the interest rate and pay off all the closing costs. I forgot to mention or go into more detail about the interest-only option. The interest-only basically means that on the loan, the borrower will only be required to pay the interest on it, which is a huge benefit to a lot of people or investors that want to have more cash flow on the property that they're currently renting out. And that allows them to have cash flow consistently as long as the mortgage payment is not too high. Warrantable and condo hotels are allowed with this lender. Even though it's a little bit more work, they do allow it, okay? Business-only loans, or for investor loans, not every lender allows every state, but in this case, this lender allows Colorado, Florida, Georgia, Indiana, Louisiana, New Mexico, Ohio, Oklahoma, Pennsylvania, South Carolina, Washington, and Wyoming, which is good to know, okay? But sorry, there are other lenders that will allow other states, so you don't have to necessarily be worried about not qualifying if you're in a state different to one of these, like for California, which I know most non-QM lenders or investor-only lenders do allow. There are many for them. Then at the end, the borrower is going to go ahead and complete what's known as the business purpose disclosure. Now let's go over an example of how the DSCR is calculated. Basically, any lender, but in this case, we're focusing on this specific lender, Angel Oak. It includes the principal, interest, taxes, insurance, and HOA fees in the mortgage debt. And then the ratio is calculated by taking the expected rental income and then dividing it by the annual mortgage debt, or RDP. Rent divided PIT equals DSCR. Now, let's follow an example here. So let's say the rental income is $1,100 and the total PITIA is $1,000. If you divide both of these, 1,100 by 1,000, we get a 1.1 DSCR positive cash flow, okay? When you break even, it basically means that you're going to get the same amount of rent as the mortgage payment. And then that way it would be a 1% DSCR. But obviously the investor doesn't want to break even. They want to be able to have a rental income or cash flow that's above what they're making in payments. So in this case, in the first option, they're making $100 profit. In the second one, they're not making any profit. Next, let's say the DSCR is 0.9% or 0.90%. Basically means that the rental income is under, in this case, under the PITIA payment, which is something that the lender simply won't allow. And in that case, the lender will require that the borrower go ahead and close in the name of a different program, which would be the no DSCR or no ratio loan. So it's still allowed, but the rate will be higher and the down payment requirements will be higher as well. So instead of coming in with 15% or 20% or 25%, they might come in with 25 or 30% to be able to close on that loan. Now, some people like to ask if personal income is required to be able to qualify for an investor cash flow loan. And no personal income is used to qualify, because it has to be a business purpose loan in order to be able to do this specific loan. This saves you from having to collect tax returns, W-2s, pay stubs, anything you would normally collect. So there's a lot of people that want to know if these types of loans close faster. And yes, they typically close faster because there's no documentation required. but these lenders still have their processes and procedures that need to be complied with, and reviewing appraisals and going over the borrower's credit still takes a few days. So that's something you do need to take into account. Now, with Angel Oak Mortgage Solutions, they do have a DSCR loan calculator. It's not too difficult to calculate DSCR, but if you ever wanted to go ahead and go over the details, for example, here we would go over the monthly rental income. Let's say the monthly rental income, let's be a little more realistic in terms of numbers. Let's say 2,800. Let's say the loan amount in this case is going to be 200,000, and the interest rate is going to be an 8.9%. Monthly taxes are $250, and the monthly insurance is $150. If we're assuming that the term is a 30-year fixed loan and that there is no HOA, we can see that the principal and interest payment would be $1,594.88, and the interest-only payment, if the borrower chose to get an interest-only loan, would have $1,483.33 as a monthly mortgage payment. And when you do the actual calculations, a fixed DSCR would have a 151.77% DSCR, which would basically means we would have to have the borrower do a no DSCR loan to be able to do this loan.